In the next few videos, we'll be looking at different investment instruments. In this particular video, we'll be talking about Treasury bills. My name is Lara Garuba. I'm your host on the Women Wealth and Wills YouTube channel. What is Treasury bills? Treasury bills are short-term debt instruments issued by the federal government of any country, US, Canada, Nigeria, any country, through its central bank to raise short-term funds from the public, from private individuals, institutional investors, NGOs, and even religious bodies. And that's for the purpose of financing government budget deficits. In Nigeria, Treasury bills are issued by the Central Bank of Nigeria, and it is guaranteed and backed with the full faith of the federal government of Nigeria. Treasury bills are issued at an interest rate often referred to as discount rate. How does Treasury bills work? Treasury bills are discount instruments, and they are so called because the investor gets its interest upfront most of the time. There's also at maturity. We'll talk about that later. This means that the interest promised on the Treasury bill instrument is payable on the very day the investment commences. For example, if a Treasury bill promises a 10% interest rate per annum and an investor wants to put in 100,000, the investor pays only 90,000 from the day of investment but gets 100,000 at maturity. The maturity value of 100,000 is referred to as face value, while the initial investment of 90,000 is called the discount value. What is a true yield? In most Treasury bills investment paper, you see yield, you see interest rate. Many people ask me, what is this? True yield is your effective return on investment, ROI. Using the illustration I just gave you above, the initial yield for the 100,000 is 10,000, is 10%, right? However, because interest rate is paid upfront, your true yield is actually the 10,000 interest received divided by the 90,000 you actually paid. That is 10,000 divided by 90,000, which has translated to 11.11%. This is, however, higher than 10% interest rate per annum. The true yield is fully earned when you hold that investment till maturity. What is primary and secondary bills? T-bills can be purchased either in a primary or secondary market. The primary market is when the investor buys directly from CBN, that's the Central Bank of Nigeria, through a public auction, which always happens every 2 weeks. While in the secondary market, an investor buys from an existing holder of a T-bills. That means you're buying from somebody that has bought from an auction. Hence, T-bills in the primary market can be bought only every 2 weeks, while in the secondary market, it can be bought every other day. The minimum amount that can be bought in the primary market is 50 million and above, while in the secondary market, an investor can invest as low as 100,000. What is a tenor? T-bills are usually issued for specific period, 90 days, 91 days, 81 days, 363 days, and all of that. That's in the primary market. The rates on T-bills are quoted annually. As a result, an investor gets the full rate only if the tenor is up to 364 days. For instance, if the rate on a 182-day Treasury bills is quoted at 10%, the investor effectively gets 5%. However, in the secondary market, T-bills can be bought at irregular tenors ranging from 1 to 363. So sometimes you see 12 days, you see 18 days, you see 33 days, and all of that. If you are finding this useful, please like and subscribe to our page and share with your friends. What do I benefit from investing in Treasury bills? You may ask. Treasury bills in Nigeria are guaranteed by the full faith of the federal government. Hence, there is no default. If the government cannot pay, the CBN can print money to settle all investors. Treasury bills are fixed income investment, and income from treasury bills are tax-free. Investing in treasury bills encourages savings, and it can be easily converted to cash. T-bills also pay higher interest than an investor will get from a commercial bank, plus the fact that T-bills certificate can be used as collateral for bank loans in some banks, not a general rule. Okay, so these are the things that you stand to gain. That's why I always recommend treasury bills, because there's low risk. In fact, some people say there is zero risk. So if your risk profile is between 1, 2, 3, treasury bills is an investment you should consider. Can I sell before maturity? Oh, yes, you can. You can sell treasury bills before maturity. However, the price at which you sell depends on the prevailing interest rate. For instance, a 100,000 face value treasury bills may be selling for less or more, depending on the prevailing interest rate as at the time you want to sell. If your face value is trading at a higher price, it means you can sell your treasury bills at a profit. As such, your 100,000 can sell for 101, 102 or more. If your face value is trading at a lower price, it means you can sell your treasury bills at a loss. As such, your 100,000 can sell for 99 or less. Please connect to the next video, because we shall be speaking about another investment and very interesting investment instrument. Continue to follow us on Women Wealth Wheels to get more information and make informed decisions about your investment and your financial goals. Thank you for watching.